The following presentation is brought to you as a courtesy from Forex Academy. This is part of our service, Become a Pro course. If you find it interesting and wish to be updated on new releases, please subscribe to our YouTube channel or join our community at forex.academy and receive all our services for free. Your like is also highly appreciated. Enjoy.
Hello and welcome to lesson 3 of the Become a Pro course. Today, of course, we will be discussing effective market analysis. I'm your host here, Robert Blackwell at Forex.Academy. So let's move onwards with the course. And before we do, of course, we like to present our disclaimer. There is risk involved, of course, in trading these financial markets. So do just view our disclaimer there. And of course, at the start of each lesson, we like to just cover a piece of housekeeping. It is, of course, an interactive lesson, so feel free to ask questions throughout. We have the chat box there located on the right-hand side of your screen. So at any time as we progress through the webinar, you will have questions, of course. Feel free to ask questions just in the chat box. I'll be able to see them. We have online support available here with Richard online as well. So we'll be, of course, able to answer your questions when they come in. This live webinar is being recorded and will be placed into your members login area once we have concluded. So if you could just give us a 1 hour grace period, we will download and process the video and you will have it fully for revision there in your members login area. And of course, we'll have a quick Q&A session towards the end of the webinar to cover all of the topics. If you have any questions, I'll be able to address them. So let's move forward with our course overview. Of course, we are now approaching effective market analysis. This is week 1, of course, of the Become a Pro course. Just to recap there, we discussed our role as professional traders within this environment, and of course, moving away from retail trading, we want to really progress on to professional disciplines in terms of our principal approach, and our objectives may shift, of course, to a more objective trading format. Of course, dissemination of information, we will discuss it in a little more detail with this effective market analysis today. Very, very important in terms of how we can properly disseminate economic data and news flow to look to trade these markets. Of course, today's structure will cover methods of analysis. So effectively, there are different market participants within these financial markets, whether you're a long-term investor or a short-term speculator. Perhaps you take a long-term profit views in the Forex markets, or you trade commodities in the short term. Of course, there are different ways to assess price action and price movement. So we'll look at really building into this lesson those various different forms of analysis and combining that with our own objectives in terms of profit taking and our decision making. So let's really delve into the lesson. And of course, we'll start with just defining the 3 schools of thought. Really, we have fundamental, technical, and sentimental analysis. Okay, so first and foremost, fundamental analysis is the examination of the underlying forces that will affect the well-being of an economy, an industry group, or a company. Okay, so whether we're trading an economy or an equity index like the FTSE 100 or the German DAX, whether we are trading an industry sector or a group, perhaps the tech industry there, we have a relevance to its strength. We prefer to trade the NASDAQ, or perhaps we'll look at those company stocks within that industry group, such as Facebook, Cisco Systems, and perhaps Qualcomm, different companies like that that offer potential. But as the same with most analysis, the goal is to derive a forecast and profit from future price movements. In terms of technical analysis now, which is more common in our approach to retail trading, of course, and because we can develop a methodology for forecasting the direction of prices simply through the study of past market data. Primarily now with price and volume as we use to navigate our technical analysis, we can look at perhaps support and resistance levels or inflection points within the market that the market does not want to move through or potentially wants to break through. And obviously in assessing technically, whether it's statistical reference or what we can see through the price action, we can underline potential profit movements. And then, of course, we have our tertiary school of thought there, sentimental analysis, focusing on identifying and measuring the overall psychological state of all participants in the market. So it attempts to quantify what percentage of market participants are buyers or sellers, so either bulls or bears within the market. And really, if we focus on any risk theme that has a strong undertone within the market, particularly if we choose, we'll discuss the equity markets for an example. Of course, it has an underlying risk theme to how strong the markets or how weak they are in terms of uncertainty or political risk, or maybe a single stock risk to one particular equity index. Of course, there's a level of sentiment where traders will congregate and shift the market in one particular way. In terms of the important factors for this analysis, whether you're choosing to trade with fundamental analysis or technical analysis or sentimental analysis or a hybrid trading strategy of course, both or all three of them combined, you'll need to really take into account different factors that will assess your own ability to trade. So first and foremost, we have timing. Timing is absolutely everything when approaching the markets, and obviously once you're able to improve your timing for entry into certain trades, you will effectively be able to pick better price points when the market moves in your favor. Now, trading is a method of buying, selling a security for a shorter time period for shorter term profits. So trading is, of course, different than what we would call investing. Today's liquidity allows quick entry and exit, and profits can be due to leverage. Investors choose to invest capital amounts for longer periods and hope not only to profit from price increases, but ownership. Okay, so a little different there in terms of how we enter the markets with timing. There is a difference between trading and investing, but of course, both I suppose methods of long-term trading is so conclusive in terms of when you enter the market, when is the right time to buy shares, whether you're looking to own them or to simply speculate on that price. Growth is another factor, of course. Trading focuses more on the movement of price and is based on more skill from timing. Okay, investing aims to create long-term value and less worried about shorter time frames. Again, so there is a difference here in terms of the timing and the growth factor that you'd like to implement into your trading strategy. Risk is, of course, of key importance. So trading involves high risk due to much higher possible returns and more frequent trading. So in relation to investing, of course, if you sit down to your trading screen, perhaps you're a scalper and you're quite good at that, of course, you'll probably make around 20, 30, maybe 40 trades in a particular trading day, depending on the assets you trade. Investors will certainly not be that prolific in terms of the amount of investments or trades they will place. Investing then involves lower risk and return and is often a more complex function of price, interest, and dividends. So typically, to give you an example of a long-term investor, their aim or their real target is to develop a larger return and beat the equity index. So let's say over a year, the S&P 500 delivers a return of 6%. My hope as an investor is effectively to compete against simply getting long the local equity index and trying to outperform the market through my investment. So picking stocks, looking for diversification to mitigate risk and getting involved over the long term. And again, there is much more of a function in terms of developing revenue through interest and dividends. Technique is, of course, key importance. So very, very different when discussing all the different factors there. We have, of course, the schools of thought with fundamental trading, your technical trading, but technique is key. Traders are skilled, technical individuals who take time to learn the market trends and hit higher profit targets in the stipulated time. Again, investors, there is a certain technique to it, completely different to your technical trader simply observing price action. Investors, well, they sit down with their fundamental analysis. They analyze the stocks they want to invest in. This includes learning business fundamentals and a commitment to stay invested for a long term. So there's a completely different technique to actually defining investment versus trading. But again, just simply looking at these two market participants when they enter the market isn't enough to define why prices move. We have to take all of these factors into account. And this is, again, starting to develop our own idea as individual traders, how we would like to define, even at this early stage, our own trading strategies. So let's delve into a little more detail then. Of course, we'll break down fundamental analysis, okay? Now, again, as discussed, it's the examination of the underlying forces that affect the well-being of the economy, industry group, commodities, or companies. So if we're looking to trade the price of oil, fundamental traders will need to know a lot in terms of the supply and demand function of that market. What are the major importers of that commodity and the major exporters, the major producers, and what standard of oil is derived and produced across the world? How is it priced in terms of the two benchmarks, WTI crude and Brent? Of course, they're the European benchmark. Are there other products? There are indeed. There's a QE, which is the Saudi Arabian form of oil, specific to the Gulf. So you do need to know, how these asset prices move in I suppose as a result of many different underlying factors in that market. And again, the objective is to derive a forecast either from future price movements or long-term delivery from a profit value. So what we'll do is really look into fundamental analysis, and what we'll choose to do, it's effectively the best way to show you how deep you can go with fundamental analysis is to discuss I suppose the objective of investors and how they, as market participants, look to speculate in this market. Well, of course, if you want to become an investor, a question for you, if you're trading an equity, let's choose another example there. We'll use the oil company Total in France. What is the share price? What is the cost, or what is the price of that share at the moment? What is the earnings per share? So of course, as an owner, if I choose to invest in this company and I'm looking for profit potential over the long run, well, I'm giving my hard-earned capital to become a very small percentage owner in this company. I want to earn some of the revenue if they outperform and they make money, given I have invested in them. So what are the earnings per share? What is the market capitalization of this company, and how does it relate to its competitors within its own environment? What are the dividends? Of course, there are payments, usually quarterly payments for investors in terms of how much money, how much revenue each company makes. They pay out dividends per share, of course. Financial growth outlook. So is this a long-term investment? Am I choosing to invest in this stock because I see it growing at an exponential rate of 4% in year one and maybe 12% in year two? If that is attractive to me, of course, I'm looking for long-term value there. And of course, is there sufficient liquidity in trying to trade this equity? Because some equity markets are actually not as liquid as you might think. So to give you one example, we have AIM there in the LSE London Stock Exchange. It is, of course, the fourth largest market after the FTSE 100, 250 and 350, the alternative investment market. So it does have some sort of small to middle sized, medium-based enterprises that go to market. They're looking for share investment, but there isn't a serious amount of liquidity. How does that affect your price execution? How does that affect your choice as a trader if you decide to invest in one of those companies? If you decide again to get out of that trade and effectively take profit from something that has arisen, but is there liquidity in actually providing or selling those shares back to the market? So a lot of factors to really take into account when becoming an investor. In terms of this fundamental analysis, let's really delve deep into some of the main focuses, trying to derive how we can find value for these assets. So as the theoretical study of fundamental analysis is focused on value assessment, its applications is much more assertive on particular asset classes, most notably stock markets. There are many practical methods of analysis used in stock valuation. So let's discuss but a few of them. We have income valuation, so otherwise known as discounted cash flow. Price to earnings, of course, the PE ratio. Earnings per share, or EPS. And earnings before income tax, depreciation, and amortization, which is EBITDA, of course. Amortization, again, another form of depreciation, just like a mortgage schedule. So EBITDA as well, a very common practice, of course, in stock valuation. In terms of income valuation, what we can actually do is look at income flow from future projections for revenue. So what we have here is present value. What is the present value of income flow for a specific company? Well, here we have a figure, of course, of 3,793. But what is, I suppose the question is, how does this relate to the current market capitalization? If I believe the present value of income flows into the company is a certain amount, well, over time, given the time value of money as we define, what is that going to be if I invest in a certain asset over a potential 5-year period or longer? Of course, so it's one method that we can assess to give you an idea to the potential growth or the potential increase in revenue from one particular company or asset over a period of time, given that they are, of course, going to try and expand and outsource potential profit. So again, the question is, how does this relate to the current market capitalization of that company? Well, then we have price to earnings ratio. The PE ratio looks at the relationship between the stock price and the company's earnings. It is a valuation ratio of a company's current share price to its per share earnings. So if you think Facebook there recently delivered something on the context of 26 cent per share, so 26-cent profit on a quarterly expectation there for a share. So you're effectively earning some money there from your shares. It's sometimes also referred to as the earnings multiple, and the PE ratio is the most popular metric of stock analysis, though not the only one. So again, this is attractive for many traders, particularly if you may look for sourcing value. So to pick a few stocks or shares, if we choose again Facebook or Google, they're very high earners, which means that they relay this on through their earnings multiple to price earnings ratio. So hypothetically, those traders who seek that value look to take long positions in these equities, look to become partial owners so that they're not necessarily concerned with the fluctuating stock price of this single equity, but they want to see flows of income over time as the company makes revenue each quarter. And obviously they are allowed a derived part of that since their investment has a stake in the company. So effectively, that's how they're looking for value over the long run. What we define as the PE ratio, of course, is market value per share divided by annual earnings per share. Okay, so with this case then, we'll discuss the numerator at the top. Then the market value per share is the current market price of a single share. The annual earnings per share, the denominator, is the net income of a company for the most recent 12 months periods divided by the number of outstanding shares of the company. So that's how we find the PE ratio there. For the market value per share divided by the annual's earnings per share will give us our ratio. Annual EPS is simply the net income then divided by the number of shares. Okay, so it's effectively our earnings per share ratio. So again, they all kind of feed into each other. We can fundamentally sit down and look at this fundamental analysis and say, which of these companies or investments provide a profit, of course, with price speculation, or is the share price going to rise? Which of these companies, of course, may provide me with serious income if I invest a large amount of capital to own some of their shares, and which will pay out dividends or earnings per share on those potential profits. So again, earnings per share is equal to the net income minus preferred dividends, minus preferred divided dividends by all shares outstanding in the market. So it simply gives you the net profit earned by each share. EPS is a key component of stock price valuation. A company's earnings per share is typically provided on the income statement. And there we have the EPS, it's net income divided by preferred dividends divided by the weighted average shares outstanding. Okay, so we're taking in the amount of income that this particular stock earns through revenue over a quarter. Of course, what they have to do is discuss paying their preferred shareholders, those who actually have purchased preferred shares. They pay out the dividends, and then we have the rest of that revenue to divide between the rest of the shares for a profit, of course, for the rest of the owners who have invested in these share markets. So here we have in front, just to give you an idea of how it feeds into our analysis, how it may feed into trading the equity index, how it feeds into investor sentiment, and the overall landscape of the macroeconomic environment. We have the S&P 500 here, price earnings ratio, CAPE. So effectively what we have here is a long data point there from the whole way back 1881 to relative price action there. And what we have is, of course, 1929, the Great Recession. We've seen a very strong bull market up to that point. At that point, of course, you can see the very high level of price earnings ratio for the stocks at that time. So those investors that were heavily invested in stock had invested a large sum of money potentially in these stocks, but of course they were taking a lot of income through the price earnings, through the actual earnings they were receiving per share on their investments. Another most notable time was obviously the big dot-com boom there, leading up to 2000. And of course, a lot of these large companies, your Yahoo companies, your Google, were creating huge sums of money in terms of revenue, and obviously relaying that into a lot of those very, very big investors that came into the market sort of 97, 98, 99. So the earnings per share for those investors was at a long-term high there in and around 42, 43 times the actual earnings per share on their investment. So a huge amount. And then we're leading up to relative times there, 2018, and now we're actually just above 27. So here with relative 2016, 26.45, 93rd percentile there in terms of the actual ratio for the amount of earnings you receive per share over the S&P basket of equities within that index. So one concern then in terms of where we are now in the global markets is that the price earnings ratio of the S&P 500 at this point in time is approaching one of the highest return rates in history. It's adding historical discussion that the US economy may be starting to overheat, because we've seen it in the past. We know that history repeats itself. We've seen the fact that we're, I don't know if I would say at the peak of a very, very strong bull market, but we're certainly we're certainly at the upper precipice of a very strong bull market, to say the least. And of course, we are receiving large, I suppose, percentage ratios for the amount of investments we put into earnings for these S&P 500 constituents or components. So that is effectively leading to a lot of profit on the table for these long-term investors. And again, fundamental analysis is there to actually assess these stocks that provide this source of revenue for investors, as opposed to simply looking to just speculate on a share and trade the price. So that is one form of market participation that can obviously provide great benefit as a fundamental trader. And then of course we have EBITDA, otherwise known then as earnings before income tax, depreciation and amortization schedule, of course. So what I've done here is just to, I suppose, add a level of interest here into this discussion and just discuss revenue growth over earnings before tax and income, depreciation and amortization, just because we have two very similar companies with Amazon and obviously the retail online giant Alibaba there. As you can see there, leading up to 2012, 13, 14, and then 2015, very significant. The revenue growth is a percentage of 20% relative to Amazon and 34% relative to Alibaba. However, the earnings before income tax, depreciation and amortization has a huge skew, with Amazon, of course, making 58% over the market in relation to Alibaba's 29%. So the question is a totally hypothetical one. What type of investor better suits your portfolio? If you're an investor for long-term growth or long-term revenue, what is the better investment for you? And there's no right or wrong answer, but you can see the amount of fundamental analysts, the amount of analysis that you need to do to actually get involved in these stock markets in terms of trading simply the price. It does have its advantages of actually looking at speculating on price movement, as opposed to getting into crunching the numbers. So that is one downfall, of course, I would argue, for fundamental analysis. But again, it relates to the type of trader or investor you are. If you're looking for ownership or long-term growth or simple revenue payout from dividends and earning per share income. So a very, very interesting topic of conversation, obviously, for those fundamental traders. So let's move on then to our second school of thought, and of course more familiar to us as traders, we have technical analysis. It is of course the forecasting of future price movements based on an examination of historical price movements. So like weather forecasting, technical analysis does not result in absolute predictions about the future. Instead, it can help traders anticipate what is likely to happen to prices over time. Technical analysis uses a wide range of charts that show price over time. That's effectively just like the weather. That's what we're trying to do. We're trying to look for probability to say that, of course, In Ireland here, it rains more often than not, so I believe tomorrow will rain. I'm going to make that trade. That's what we're trying to do with our technical charting skills, of course, to price the probability of these markets or directional movement in our favor. So what we'd be more familiar with is this sort of a technical representation. And I have just two charts really to discuss and outline the advantages to this for us as traders. One, of course, because we can simply look at what we have in front of us. So as technical traders, they aren't focused necessarily on, crunching numbers, looking at earnings before income tax and depreciation and amortization of an equity. Perhaps they're not too fussed about studying the prices of wheat and why the US is such a huge exporter of their wheat, how that is priced in Europe, how that relates into different commodities as well, how seasonality may affect the markets. What they simply are concerned with is, well, the price is moving in such a way that we as technical traders believe that as price movement, all new information relative and released to the market is, of course, traded. People trade upon this news, and that is embodied. That new news available is embodied in the price. So we can simply take that as an assumption with efficient market analysis and look to trade that price. So here we have technical representation here. The chart in front is actually the Chinese equity index, the A50, a leading blue chip, heavy weighted in industrials and construction, of course. The study of historical price data over the long term is extremely important for long-term traders. Okay, so I just discussed a lot of fundamental analysis, and it was more particular to number one, investment over trading, and number two, long-term investment, as opposed to those short-term speculators who want to get in and out of the market. We can also do that, guys, with technical representation. So technical analysis doesn't mean we have to simply trade on a 30-minute price chart. No, certainly not. We can look at the long-term highs here in the Chinese equity index, and this price action here from left to right is, of course, starting in May 2012, the whole way relative to this day, February there, of course, with this price action dated. We see it move from February to this relative day in April now, that we can actually see the price action bounce off this long-term high. So if we're looking for signals when we might look to sell an equity bull run, of course, if we see historical price action over the long term, maybe we want to trade long term, well, we have an inclination to when that might be likely. Of course, what we can do is assertively suggest that we can study the current price action in the short term. It's extremely important for not only day traders, but short-term speculators. So that is one advantage to actually technical representation of price, the fact that we can effectively decide what we want to do. So you might have one trade in one market, let's say the gold market, and you believe that is going to be very bearish over the next 3 months because the dollar is very strong. That may be the case. So you've decided to take a long-term view on gold, whereas you might simply take a day trade in the German DAX because it's looking very strong today, and you might have simply bought it off the open and it's starting to move up, so you're managing that trade and you only want some profit during the course of today. Two completely different trades that you can do with technical representation, that you can do on your own trading platform, and that you can, I suppose, have the ability with leverage to assess when is the best time to enter. So what we have here is, of course, US oil in front, and I just circled a few points because it may be more interesting than you think at first reference points. We have, of course, some indecision with our candles here, just telling us that the market was trading down with candle 1, then 2 here, showing us a spinning top indecision. We literally get the reversal in the next 2 candles, and then we're away to the upside. So just a simple rollover effect. And again, we see something very similar here with this price action reversing. The candlestick tells us again, it gives us the signal. Again, if we're deciding to trade these daily candlesticks here, we can simply make day trades or hold the position for maybe a week or 3 days. It's entirely up to ourselves. Yet again, we see a very strong bearish candle and the market reverses within that day. And then we see another shift. So again, there's clues the whole way across this price action to actually identify potential moves in the market. If we can do so effectively, perhaps we shouldn't be so concerned with long-term moves in the markets. And again, look, it's going to be a question for yourself going through the Become a Pro course. what type of trader you'd like to be, what term of trader you'd like to be, or potentially you can of course decide both, that you'd like to include fundamental analysis, technical analysis, you'd like to take short-term trades and long-term trades, and you'd like to trade price action as well as long-term investment opportunities. It's all available to us, guys, and that's the point and the key for learning. And the more learning we take on board, of course, the better we'll be at it. That brings us nicely on to discussing sentimental analysis, aiming to assess at all times who is in control of the markets. Okay, so who is in control of the markets? Apart from our technical analysis, apart from all of the fundamental analysis that we can build into our price study, what we can try and ascertain is a simple level of control. Who is pushing the market in one direction or the other? Is it the bears? Is it the bulls? Buyers and sellers? Really, that's all we need to focus on in terms of trading decisions. They can be made either in the short or long term, simply looking for sentiment change and maybe perhaps news events to cause a sentiment shock. And again, while long-term traders, they might take a long-term approach to price speculation that a market may rise over the long term. Well, we know that markets don't trade in one single direction. Sentiment traders might get in there and just exploit the volatility that's in there with these markets. So again, what we can do is really have a view on assessing all types of analysis, of course, but decide for which market, which one is more suitable for the market in question, which one is more suitable for us, or potentially we'd like to include all of them in one particular trade or none of them in a particular trade. Again, it's all sort of to your own judgment. So the point again is we need to inform ourselves. We need to conduct the proper analysis. Okay, so it does rely on a few things. The type of analysis conducted can depend on the asset in question. So the question I would like to pose here to our audience is of course, what do we think? Do you think, is that true? The type of analysis conducted can depend on the asset in question. So is there a difference to trading a commodity like gold than potentially a commodity or new asset like Bitcoin, as opposed again to a Forex pair? What do we think? Is there a total difference in the way we approach that market? Well, of course, for each particular asset in question, it will trade differently. So we need to take that on board. We can also dictate with ourselves the duration of the trade. So our type of analysis may be as a result of what trade we want to take. I don't know what's going to happen, for example, in the next 3 days, but I'm pretty sure with my fundamental analysis that the price of cocoa is going to rise again over $3,000, and something that's currently at 2,800 certainly will give us a profit target of around $200. So I'm fairly convinced with my fundamental analysis that is the case. I'm going to allow myself a 2-to-1 risk reward with a $100 loser. That most certainly may be the case. So the duration of that trade might take, of course, the next month to deliver that return. Whereas you might simply look to get involved in short moves in the market intraday. Of course, there's a totally different level of analysis for that. So fundamental analysis is often a much more definitive method of assessing value for asset prices, dominated by supply and demand, where technical analysis is a favored method to trade assets that have an unquantifiable number of variables that dictate price. Why is that? Well, because trading, we're really focused on volatility. We want to involve ourselves in the volatility in these markets, and when something has a huge amount of variables that moves price with that volatility, well, we like to get involved and make money.